right. So we have a truly terrific panel for this afternoon session, evening session, which really follows on from the terrific session that we've just had, looking at the different forms of governance.
Yeah, tell me how you do it.
Oh,
Do it right now.
Yeah.
oh, we're sharing screens.
So what did you do to? Oh, you clicked on the Zoom.
You ready?
Oh,
I think so.
we're ready. We're ready. That's Timmy. Okay, so the man needs no introduction. I'm not going to bother with one.
You go on the full
Coase
screen mode. Yeah.
Full screen mode for Coase. So Coase is obviously a professor at NYU. Is going to give us a sort of general understanding of the comparative framework for corporate governance. So Coase, I'm not going to bother introducing you. You are just yourself. So take it away.
Thank you.
10 minutes.
Thank you, Yesha. So I've been thinking about agency problems and corporate governance for a while, and I'm going to give you kind of a bird's overview of the corporate governance literature, in particular, thinking about comparative corporate governance. So corporate governance has been in some of the developed economies, the US, Europe, and then go into emerging markets kind of thing. So let me start with asking corporate governance why it's important. So here it is. This is the finance view of corporate governance. So let's say I have a project, I have a great idea, which involves $100 million. And let's say the entrepreneur, the person with the idea, doesn't have much finance available. Now, this is going to generate, let's say, $127 million in the future, maybe several time periods. Now, the central question here is, how much of this $127 million is pledgeable to investors? You know, for various reasons, this $127 million may not be, even though the project generates this cash flow, it may not be pledgeable to investors, whether they are debt holders, whether they are equity holders, and so on. And how much of it is pledgeable depends on the economy. You know, how good are the institutions? How good is the legal system? How good are the markets? How good are the banks? A bunch of things, and the corporate governance. So that is one way of looking at corporate governance. And the central issue is, thinking about investors, the pledgeability of these cash flows to investors. And that's important, as it turns out, because if only 90 million of this is pledgeable, the project doesn't get off the ground. Because, remember, the entrepreneur doesn't have a lot of money, so you need investors to finance it. So it's focused on finance. But if 110 million of this 127 million is pledgeable, then it gets off the ground. So needless to say, this is kind of a central issue, and it has implications for access to finance, growth in the economy, what fraction of the great ideas, innovations in the economy actually gets implemented, all kinds of good things. So that's one way. So again, the focus here is on finance. And again, I'm going to talk about how in different economies, this simple concept gets implemented differently, and the agency problems and the governance issues are actually different when you go around the world. Okay, now let's broaden this idea. And this actually, people have started thinking about it in the context of infrastructure financing, social entrepreneurship, and so on. And here I have a similar question. So you have this great idea. It takes $100 million. However, now the benefits of it, 40 million of that is cash flows. 90 million, it turns out, these are non-monetizable benefits coming to somebody in the society, okay? So for example, think of it as, you're innovating a vaccine. It's a poor country, so the investors, the beneficiaries are not really going to be able to pay for it. So in other words, there are benefits now, $90 million worth of benefits, but it's not really monetizable. It's not really automatically monetized, okay? Now, out of the 40 million though, which are actual cash flows, it may be, collections at the Eurotunnel. It may be actually part of the price of the vaccine is actually paid by somebody and so on. So even that, there are some issues of pledgeability and so on. But there is another aspect now. It's not focused on so much the financing of it. It also focused on the total benefits to society. So, again, a larger theme such as corporate social responsibility, various other things come. And there are some very interesting governance issues here, which are beyond the governance issues in the first prototype that we talked about. Okay. For example, let me give you some interesting issues. There is a paper on financing the Second Avenue subway. This is in New York City. So clearly, it costs some umpteen $billion, but nobody believes that the subway toll is a large fraction of the cash flows coming from it. Now, what happens is, of course, but everybody knows it has incredible benefits to society at large. In particular, the real estate around the subway line has gone up in price a lot. Okay, so these are beneficiaries of it. Their property values go up. However, they're not standing in line to pay for it. So, of course, what the government did is, of course, to collect property taxes. But there is a paper which shows still, even though it is a clever way of monetizing some of the non-monetizable benefits, it is only a small fraction of the actual cost of the subway line. Okay, similarly, you can imagine cases, vaccines for people in poor countries. Shanghai Airport, for example, every time I walk through Shanghai Airport, they have this magneto-leviton technology which whisks you into Shanghai in about 12 minutes. Clearly, nobody expects the tolls to pay for any part of it, actually. But again, there is, the government would say, Shanghai government, Shanghai provincial government, as well as the federal government would say, there are incredible benefits of that project. It makes China look good. It makes all the governments I mentioned look good. So there are a lot of non-monetizable benefits coming out of the project. And as you can imagine, there are political issues, corporate governance issues, all kinds of fascinating issues there, which has now become part of the corporate governance literature. And one central difference you notice between the first paradigm and the second paradigm is that now various stakeholders are central to the issue. As you know, Jean Tirole actually talks about governance as design of institutions that induces management to internalize the welfare of stakeholders. So this has now become a central part of corporate governance. Let me quickly, I don't have much time. If you look at the 30, 40 years of the corporate governance literature, the first 22 years, I would call it corporate governance and second best contracting. So in other words, a lot of emphasis, including Jensen and Meckling, including principal agent paradigms, that was focused on, yes, you have incomplete contracting. What can second best contracts do to fill the gaps? Okay. Now, the next 22 years, that is Andre Schleifer and company, law and finance kind of way of looking at it. That focus, it's still agency problems, still governance issues, but the focus shifted on to institutions and legal institutions being primary. Okay. Now, in corporate governance itself, people make a big distinction. They say the corporate governance in US has been focused on what is called the vertical agency problem. That is, you have the owners, these are shareholders, and the issue is whether the managers are sufficiently aligned with the owners. So, separation of ownership and control, or the vertical agency problem. But they say, so of course, the solutions, as you know, are boards, takeovers, large shareholder monitoring, and so on. However, people rush to tell you, the corporate governance problem in emerging markets, though, it's not quite that. It is actually this. Managers are, of course, sufficiently aligned with the controlling shareholder, but the issue is whether together they are able to exploit the minority shareholders. Again, going back to pledgeability, this would, of course, importantly affect pledgeability and how much outside financiers hope to get a return on their investment. Okay, so so it's still important, but the issue is, that's why it's called horizontal agency problem. The issue is CEO plus the controlling shareholders. How much do they exploit the minority shareholder? Now here, since we are talking about China and other emerging markets, the concentrated or controlling shareholder can be the state. And that brings in a lot of interesting additional issues. For example, that the state doesn't quite have the alignment of the shareholder with what's going on in the enterprise. State has its own priorities. State worries about stability, employment, all kinds of things. So the agency problem actually shifts. It softens it a little bit. And that might improve the exploitation of the minority shareholders. However, it does reduce the alignment of the shareholder with the enterprise. All right. There is a wonderful survey, actually a recent survey in the Review of Finance. I have some papers on that as well. Many. This is a huge, big literature in finance, management, law, economics, a lot of different areas. I'm not going to take up any more time because I'm anxious to listen to all the other panelists. So Yesha, I'm going to stop here and then let you take over.
Wow. Okay. Thank you, Koos. That was terrific and big picture, and sets the scene for us to move the panel forward. Jesse's going to take us to China to discuss the corporate governance role of the Chinese corporate governance model. So Jesse, over to you.
Okay, I'm going to.
Do you want me to have a go at?
Let's see.
Okay, I've disabled.
Can you hear me?
I can hear you.
Okay. I hope that's for the better. So this is a paper with Ehud Kamar on the law-proofness of the insiders of Chinese firms that are trading in the United States. So since I only have 10 minutes, I'm going to talk rather quickly.
Jesse, you can take more if you need. It's fine. By the way, can everyone see Jesse's slides or not?
So they're actually right next to my head.
Oh.
Yes, at least I can see them.
Okay, perfect.
So,
but Jesse, I'm seeing it small. Is there a way I can see it larger?
buy another monitor.
No. I'm seeing it as one of the, small grids. Maybe I'm doing something.
Go into speaker view and you'll see it full.
All right. Thank you.
Yeah.
Okay.
Sorry
Yes.
about that. I'm using fancy minicam technology that I used in my courses this fall, and it's probably confusing people.
No, it's good now. Yeah. Thanks.
Okay, excellent. So I'm going to talk about the role that corporate and securities law plays in protecting investors. Then I'm going to talk about Alibaba as a prototypical China-based US-listed firm that's domiciled in the Cayman Islands. I'm going to talk about the effect of having the insiders' records and assets of the company being located in the mainland. I'm going to talk about the effect of Alibaba's Cayman domicile, the effect of its Hong Kong listing, and then the implications for securities regulation. So basically, as Jose just discussed, agency problems are a big focus of concern in companies generally and publicly traded companies as well, and especially those with a controlling shareholder, where the controlling shareholder can expropriate the minority. And there are all sorts of expropriation risks in a firm with a controlling shareholder. There could be, self-dealing transactions before the firm ends its life as a public company, and then when it ends its life as a public company, the controller can take it private at a low price. So law can reduce tunneling risk. This should not be that controversial. But in order for law to work, it has to be enforceable. You have to be able to throw people in prison, seize their assets, and collect information to hold them liable and potentially embarrass them. If you can't actually enforce the laws, then the people are what we call law proof, which undermines deterrence. So let's talk about Alibaba and Jack Ma. So Alibaba is based in China, so it's under the dotted line. The controlling shareholder group and most of the officers and directors are in mainland China. They own about 10% of the equity, actually less, of the company. About 70% of the equity is held by US investors, and about 20% is now held by Hong Kong investors because Alibaba did a secondary listing in Hong Kong. Alibaba is domiciled in the Cayman Islands, and we'll talk about why that matters shortly. So it's domiciled in the Cayman Islands, based in China. Most of the investors are in the United States. So the biggest problem that US investors have in trying to enforce securities or corporate law against the insiders, or for a regulator who's trying to enforce securities law, is that the insiders' assets and information are behind what we call the Great Legal Wall of China, which basically makes people law-proof. There's no extradition, you can't enforce judgments, and it's very hard to get information, as I will explain in more detail. So first of all, there's no path to punishment. If you want laws to actually work, you need to be able to threaten people with the possibility of jail or losing their assets. There's no extradition from the mainland to the US. There's no treaty. There's never been a case where a mainlander has been extradited to the United States for infractions relating to a corporate governance case or securities litigation or regulatory enforcement. Sometimes mainlanders go into Hong Kong. Hong Kong used to have an extradition treaty with the United States, but that was suspended. And even before it was suspended, the mainland has pressured Hong Kong not to extradite to the United States. So we can't get their bodies to get them to testify or potentially to imprison them. We also can't enforce US monetary judgments in the mainland. There's no enforcement treaty for private judgments. And the federal government has some treaties, like mutual assistance treaties, with Chinese agencies, but they have not been successfully used to enforce judgments. The Chinese have just refused to use them. It's also hard to get information from China. You can't take depositions there. You can't even do them by phone. That's a criminal violation of Chinese law. Service of process is very slow. The biggest problem is that most of the documents that you would want to get in corporate litigation are potentially covered by a variety of Chinese state secrecy laws. And so you just basically can't see a lot of the documents that you would want to see. For the federal government, in theory, it's a little easier to get information because they have sharing agreements with Chinese regulators, but when push comes to shove and the US government wants to get information, the Chinese refuse. Not in every single case, but in most cases. This Great Legal Wall is not merely theoretical. It's not like I've gone and read statutes and judicial decisions and commentary and tried to figure out exactly, how enforceable the law is against mainlanders. We know that there's a Great Legal Wall because we had a wave of reverse merger frauds between 2010 and 2014, where a bunch of Chinese companies listed on US exchanges via reverse mergers. Turns out a lot of them were fraud. US investors and US regulators went after them, after the insiders. They couldn't get any money from anybody. They couldn't really figure out what happened. Obviously, no extradition. When the stock prices of these firms fell, there were probably some good firms among this group of reverse merger firms. The good firms took advantage of the stock price drop just to do cheap go privates. So we know the Great Legal Wall of China is there, and we know people are willing to exploit it. What about the Cayman domicile? So I don't want to get too wonky here about corporate law, but basically, you can either bring securities or corporate law claims against defendants. Corporate law claims in the end are probably the most important because securities law just requires you to disclose things. Corporate law actually makes it illegal to steal from the company, but you can't really enforce Cayman corporate law against Chinese insiders. You can't effectively bring a case in the Cayman Islands because on behalf of public shareholders generally, because they don't allow contingent fees. There's a loser pay provision. And so there has never been a case brought by public investors against the insiders of any Cayman domiciled firm that's publicly traded in the history of the Cayman Islands. It's not just a China thing. It's just you can't really bring a lawsuit there against, you can't, on behalf of a bunch of people, bring a lawsuit against insiders of Cayman domiciled companies in Cayman. You could try to bring the suit in the United States where contingent fees are allowed. The problem is that if you do that, there are all sorts of procedural rules that make it hard to reach the Chinese insiders, and they typically will knock these claims out. So that's sort of the main effect of a Cayman domicile. There's also a securities law effect because when Alibaba is, because it's domiciled in Cayman, it is subject to a much more relaxed disclosure regime under our securities laws, and so it doesn't have to disclose as much. The SEC also doesn't seem to have much interest in going after companies that are domiciled abroad that list on our exchanges, and that's well documented. So the Cayman domicile just makes things worse. What about a Hong Kong listing? So Alibaba in the last 2 years, they did a secondary listing in Hong Kong, which technically is part of China, but that doesn't really help US investors. First of all, in Hong Kong, just like in Cayman, you don't really have private litigation because you don't have contingent fees and there's a loser pay system. So basically, you just have regulators there who enforce the law on behalf of investors. But the problem is that Hong Kong, like the United States and like the Cayman Islands, is on the far side of the Great Legal Wall of China. China has walled off Hong Kong, so there's no extradition from the mainland, there's no enforcement of judgments in the mainland, and there's limited information sharing with people in Hong Kong. So, Hong Kong is so close yet so far from these insiders. So what prevents Alibaba insiders from massive tunneling? There are a variety of reasons that we talk about in the paper. We speculate, maybe they have ethical beliefs that cause them not to fully exploit their law-proof status. Maybe they care about preserving their reputation in the US. Maybe they want to be able to travel to the United States or to other countries that will extradite to the United States. Maybe they're afraid of China. Maybe China would be unhappy if they were to massively loot Alibaba because it would be embarrassing to China. Maybe there are people at Alibaba who are not Chinese nationals. We know there are. Actually, I've met some of them. And these Chinese nationals don't want to get these people in trouble. It's probably a mixture of these things. And that's sort of what keeps the system working. But in terms of the enforceability of the laws against the people that actually wield power there, we don't have it. So what is the implications for securities regulation generally? So my co-author and I have a fundamental disagreement about whether private ordering works at the IPO, and so we haven't come to a very sort of strong conclusion. But here's what we both agree on. We both agree that the U.S. securities regulatory system is biased towards Chinese entrepreneurs, or foreign entrepreneurs more generally. Because if you're a foreigner and you come and you list in the U.S., you can choose a securities disclosure regime that's much lighter than if you're American. When it comes to enforcement, when an American takes his or her company public, you can't really modulate enforcement risk. You can't like cap damages or say that class actions, there should be no class actions. Instead, there should be arbitration or something like that. It's basically one size fits all, no tailoring. But if you're Chinese, you can sort of modulate the degree of enforcement by having more of your assets in China, more people in China, more records in China. And you can basically create like an enforcement spectrum depending on where you locate things. And an American obviously can't without massive cost because they're not going to expatriate and they're not going to like move their business to some other country. So we both agree that the system is sort of biased towards foreigners. We both agree that it would be desirable to level the playing field. Who thinks that investors can't price protection at the IPO and thereafter, which is a view that's shared by the SEC, by legal regimes around the world, basically, that you need mandatory rules. If you need mandatory rules and you think that American investors can't really understand what's happening and need to be protected paternalistically, then we need to like require more disclosure from China-based companies, and we need to not allow companies with law-proof insiders to list in the US. I'm not sure he's wrong, but I'm more open to the possibility that corporate governance works in mysterious ways, and maybe the market can get it right and investors can be protected even though Chinese insiders are law-proof. If that's the case, then we should relax a bunch of restrictions on U.S. investors and let them, U.S. entrepreneurs, and let them engage in more tailoring when they take their companies public. That's it. Thanks for the extra time.
Wonderful, terrific, Jesse. If you have questions, we're going to try and keep around 15 minutes or so towards the end. Actually, probably more than that, if it's possible, to discuss some of these issues. And my presentation very much follows on from Jesse's work in this. So I will just figure out how to share my screen, if I can just have a minute. I'm actually using my old man's computer, and sorry, just 1 second. Perfect. Does that, can you guys see that? Perfect. Okay, so thank you so much to Susan for putting together another fantastic conference for all of us at such a crazy and intense time. You are obviously the COVID vaccine that we all need in human form, and have given us this video that we look forward to. So in addition, obviously, I'd like to thank the people who are doing the real work for putting this conference together. That is Jyoti, Ami, Shaina. They are the most marvelous, wonderful, effective, efficient people you can ever meet. This is why we have Zoom instead of Doom for us for our event today. So thank you guys so much. Many, many hugs for you next week. Okay, so given that it's 2020, and I think I can speak for most of us to say that it's been a pretty miserable and crap year. But imagine if you were one of the few people, or rather the one person, whose wealth this year would increase somehow to $71.1 billion. putting you in the top sort of 10%, top 10 of all of the richest people anywhere in the world. Now, if you had that kind of money coming in 2020, what would you do? Would you A, call up your friends in Switzerland? Hi, how's it going? Would you B, call up Elon Musk and offer to share his stash of ideas, obviously? Or would you C, stand up in front of an international group of financial industrialists and regulators and say the following words about the people who regulate you, right? And unfortunately for Jack Ma that Jesse was just talking about, he decided to choose option C. And just a few days before the blockbuster Ant Financial IPO, Jack Ma decided to criticize and critique the Chinese regulators and the entire Chinese financial system by calling it a pawn shop for old people. There's no problem. This is out of date. It's stifling innovation, right? And just a few days later, surprise, surprise, the blockbuster IPO was pulled. And this was an IPO that was going to bring $37 billion worth of capital infusion into Ant Financial, right? This was an IPO that was subscribed something like 842 times, right? It was going to bring incredible amounts of trading volume to the Shanghai Stock Exchange, lots and lots of limelight and discussion, and a big zuck you to Facebook, right? That was going to be overtaken by the Ant Financial IPO in terms of size and prestige and impact. So the big question, of course, is why the heck did the Chinese regulators pull this IPO just a couple of days before it was going to go full Bollywood? Now, obviously, we're all very cynical in this room. We're all so cynical, right? That is our job. So obviously, our cynical explanation is that this guy stood up, said all this stuff, slandered the Chinese regulators, and therefore they showed him who's boss. But a more interesting explanation and the official account of what went on points to Ant Financial being considered as not just being a tech company, right? But rather Ant Financial doing things in the payment space, in the asset management space, in the money market space, in the credit space, that made it seem much more like a bank, and that should have been regulated much more like a bank and governed in corporate governance terms much more like a bank. And that the IPO, therefore, was presenting a kind of risk to investors that was not highlighted in the disclosure documents. Now, the Ant Financial problem, how do we categorize an institution and a company like this? As a tech company, as a finance company, how do we regulate it, right? This is a challenge and a quandary that is being faced by regulators across the globe when trying to deal with innovative corporate firms that are involved in fintech activities. Now, here in India, obviously, we're dealing with firms like Paytm, for example, that from 2010 to 20 has become just an incredible presence in the Indian financial system and payment space. And, you know, what my co-author, Chris Brummer, and I, what we argue is that regulators face an almost impossible challenge in being able to regulate these firms effectively and in being able to balance the trade-offs between financial innovation, market integrity, and legislating and rulemaking in a way that is simple and clear. And what we argue is that regulators can at best achieve only 2 out of these 3 objectives. So when trying to build innovation through very clear and simple rules, for example, by giving firms lots and lots of permission and room to grow, market integrity is put at risk. Governance is put at risk. We saw that in the case of Ant Financial, that was given lots and lots of permission to grow until, of course, the Chinese regulators discovered that it was far too big to fail for the Chinese financial system as a whole. Alternatively, if you want to have market integrity through very simple rules, for example, banning things, like banks cannot do underwriting business or banks cannot do prop trading, right, then arguably you stifle financial innovation. And finally, if you want to have it all, if you want to have your cake and eat it and have market and integrity and strong governance as well as innovation, the rule book is going to look pretty complicated. So what we argue is that financial innovation and regulating financial innovation as a whole is subject to this trilemma. And this trilemma is much, much worse, much more complicated, much harder to resolve in the context of fintech companies. Now, all of us in this room, right, we're all pretty familiar with fintech. We've researched it. We've talked about it. Coase has written entire, papers and papers and papers worth, talked loudly about fintech, as Coase does. And what their products and services tend to be characterized by is this reliance on very sophisticated artificial intelligence and algorithms to drive cool services like online lending, robo-advising, these fantastic retail brokerage platforms like Zerodha that are giving access to millennials to the shares and markets and micro-targeting them through sophisticated algorithms, right? The use of AI and algorithms and offering just an incredible smorgasbord of services and products, and in using novel and interesting types of data. Right, in the online lending world, for example, the firms are using alternative data that is picked off of your phone, your contact list, the punctuation that you're using in your text messages, your geolocation, your Facebook feeds, your Twitter feeds, whether or not you shop inside a petrol station when you fill up petrol, whether you buy junk food or not when you go into the petrol station to pay. Right? So lots and lots of alternative data that is being used, data that never even existed 10 years ago. Right? And the most interesting part about fintech today is the emergence of firms like Ant Financial, like Zerodha, like Paytm, that are new, that are fringe, that have never before been mainstream financial institutions, but that now occupy an outsized place in our financial systems. Apple, Google Pay, Facebook, Plaid, Cabbage, and others, firms that we never heard of, we wouldn't have imagined, right? Becoming critical players in the financial markets today. And what we argue is that these three features make regulating financial firms and governing financial firms, fintech firms, very, very tough indeed. Firms like Alipay and Financial that Jesse was just highlighting and talking about. Firstly, right, these fintechs present large information gaps. Now, Jesse was talking about the more complicated corporate governance picture, right? But here we have the use of technologies that present this proverbial black box for regulators, right? How do we understand how this fantastic AI actually works, right? How do we understand the functioning of the learning that is bringing to the fore? Right? Appreciating that black box, figuring out what it means, presents informational hurdles for regulators. And whilst they could always use data to understand the functionings of algos and how these might work in a predictive sense, the data that firms are increasingly looking to and relying on are a very recent vintage, right? They don't have a particularly long history of testing. Right? We don't know whether your social media posts about the election have any prediction value about whether or not you're a real default risk or not. Right? Does it matter that you eat a lot of junk food? Is that important for pricing your default risk and credit? Right? Does it matter whether or not you have crap, text message punctuation? Does that tell me anything about whether or not I should lend you money and what price I should lend you that money at, right? These are not tested data points that we can use to create a robust and reliable sort of guide to the outcomes that we might expect from the delivery of financial services and products. Now, there have been numerous studies, for example, by the Fed, there was a big one on online lending. And again, the results were inconclusive about how strong the credit risk assessments were using these alternative data sources. But quite possibly the most interesting and complicated and tough problem for regulators is overseeing the governance of firms that are completely brand new, that are small startups, that are non-traditional firms coming into the financial marketplace, like Alipay, for example, like Play, like Cabbage, like Paytm, that really have no experience and expertise on Wall Street, right? Their history on the financial markets is very, very recent. Right? These are not firms that have the deep pockets, the big capital buffers, the big legal departments that can sustain the kind of compliance environment that banks are used to and used to working in and operating with. Right? So we're dealing with firms that are creating systemic risk for our financial systems, but for which we cannot easily deploy the same regulatory levers that we've traditionally relied on, because these firms are smaller, they're newer, right? They don't have the capital buffers or the culture, the compliance culture that we relied on. And the choice really is whether or not we want to harness their innovation potential. And if we do, how do we do it in this context? Now, in terms of the international picture here, that makes the trilemma and regulating fintech and fintech governance much, much more complicated. Right? Regulators have to agree as a whole on these informationally dense questions of how algorithms work, what kind of risk they present, how the data should be analyzed, right? So just coming up with some kind of agreement as an international body is very tough. As Jesse just talked about, we're unable to regulate and coordinate between two enormous markets, China and the US. Right? We have an uncoordinated system in which Chinese insiders in the US that are selling securities in the US are basically law-proof. Right? So we cannot come up with a system of international coordination. It's hard to, in which we are achieving consensus on the risks of complicated technologies that even domestic regulators are not being able to fully comprehend. Now, what's more exciting in some ways as a problem for regulators is the fact that fintech and fintech companies have evolved to fill a gap that mainstream financial companies like banks and investment banks have left behind. Right? So in many economies like China, for example, WePay, Alipay, right, and financial, they've stepped into the breach where traditional banks just did not, what traditional banks were just unwilling to go. Right, today, Ant Financial has over 1 billion monthly users of its payment services. Right, Paytm has approximately 350 million users. Right, this is not a joke. Right, these are companies that have emerged to fill a real domestic hunger for financial services. We just have to look at the rise of Robinhood in the US or Zerodha here in India, right, to see the kind of enormous appetite for millennials cooped up in their houses in lockdown, right, instead of being outside, trying their luck on Tinder or whatever, right, that the enormous appetite that, for trading stocks. Who'd have believed it? And these companies have stepped into the breach, taken advantage, and have cemented a place within that environment. So arguably, what we have here is that countries in which the population has a real stake in these services working well, right? Thinking about China, thinking about India, right? Where there's a real economic need that is being filled by these fintechs. The policymakers here arguably have the lowest incentive to act to impose costs on these players and thereby increase the cost of the services and the goods that are being provided. So, the real people who should be moving, whose populations are potentially failing risks on account of misfiring products and crap governance, those policymakers arguably have the least incentive to act because of the political economy of imposing regulatory costs that would make basic financial services like payments, lending, banking, share trading difficult for their local populations to achieve. And again, I would like to make the point, just to conclude, right, that we're dealing with companies that are very, very strange as far as financial services are concerned. For all of us that have grown up doing banking, that have, studied bank governance, that have looked at banking regulation, this is a whole new beast, right? Trying to analyze and implement the governance and trying to impose rules on companies that are startups, providing encryption, digital wallets, providing small parts, small services in the larger chain of financial services. Companies like Plaid, for example, that connect your bank account to a whole host of non-bank apps like Venmo and Robinhood, right? These are creatures that we are not familiar in dealing with. So the question is, how do we build a system of international coordination when information asymmetries are hard, consensus costs are going to be super hard to achieve, the data is new, and the companies we're dealing with won't have the deep pockets and the resources to comply with the regulatory and governance requirements that we ask of them. Unfortunately, this problem is here. So as we know with Facebook, Facebook Libra, other companies, other competitors, the international marketplace for fintechs is the next big frontier. So how regulators answer this question is really an existential one for the larger system of governance for global financial regulation and global financial governance that we're used to having since the financial crisis, certainly, and even before then. So I don't want to take up too much time. I thought it'd be fun just to leave these questions for discussion. We have around 20-25 minutes to talk about some of the issues that have been raised in this panel. So I will just open it up really, and stop the screen sharing. So there we are.
Yesha, do you mind if I take the first question?
Go for it, Brian. It's all yours.
Yeah, I was possibly going to be on this panel, but I'm now the first questionnaire. Great
for it.
panel by all three of you. I'm taking my my refrain for 2020, which is from Dr. Strangelove. It's the how I learned to stop worrying and love the bomb. And I think it applies pretty well to both Jesse's paper and Yesha's, in the sense that I wonder if, so in Jesse's context, it's probably right that there's complete law proofing here, and I think it's going on, but I wonder if all of the set of background, let's call it non-legal things that are binding Jack Ma and other insiders at Alibaba or any other companies in a similar situation are actually quite a bit stronger than we think. And if we really don't need government to solve this problem, if to say the set of robustness checks that are already there, like the way an engineer would think of multiple fail safes for a system, might already kind of be in place. And I think, Yesha, a similar thing might apply in your setting. Like, even if we get to the point where we say international cooperation is completely going to fail, regulations completely going to fail, is it really as bad as all that? Meaning, does the set of how people behave in some sort of, I don't know whether it is, this is the postmodern take on cynicism, if you will. You get so cynical that all of a sudden you're happy again, which is my how we learn to love the bomb take. Anyways, I'll leave it there to both of you, and I'm not sure if we need to investigate those other mechanisms, those non-legal mechanisms, and whether they can actually fill an important enough gap that we just don't need to worry.
Yesha, you want me to say something first?
Yeah, go for it. Yes, please.
Okay. So I'm somewhat open to the idea that we actually don't really need to have insiders against whom we can fully enforce the law and things can still work. But if that's the case, and we say this in the paper, then basically we're over-regulating American entrepreneurs. Because if these sort of non-legal constraints are as powerful as you think they might be, Brian, then they would also apply to somebody like Mark Zuckerberg, and we don't need to impose the full force and extent of our securities laws on Facebook. People should be able to take companies public, tailor their arrangements, and say, yes, we're not subject to as much law enforcement as other companies, but you can trust us for this reason, or just draw your own conclusion as to whether we're reliable or not. So I think that however you come out on the issue of whether law proofness is important, you'd have to agree that there's something incoherent in our securities regulation, because when it comes to like people like Mark Zuckerberg taking their companies public, we say, we're basically going to treat you as if you are sort of, nobody knew you, you didn't care about your reputation, you did not have ethics, and we're going to, we're not going to let you sort of modulate the degree of disclosure or the degree of enforcement, and that's probably overdoing it.
That seems fair to me.
I mean, I think, just From the international financial system point of view, I just wonder whether we have enough of an idea of the risk that's being created to be able to know whether or not other mechanisms can function effectively. One mechanism here may be some kind of private industry, peer supervision, for example, that could exist, disciplining between firms to call out those that are unsafe, for example. But again, I'm not sure whether or not that will work to the extent that, one, what would happen if, for example, Alipay were to fold or WeChat Pay were to fold? Can WeChat Pay and Alipay successfully monitor each other when they are in a small set of firms that are specializing in this kind of practice? Do banks have bad incentives to over monitor these firms because they want to protect their own position? So I'm not entirely sure whether the success of these traditional metrics can work in a system in which there is a high degree of information asymmetry at present to fully understand A, the technology, and B, also the impact of what could happen if these technologies were to fail. The idea that somehow Paytm would just go offline tomorrow in India, I think would be a very hard one for populations to think what would happen to the payment system. So again, I think that could be like a gap here. Pargavi, I think you had a question.
Yeah, hi, Asha. Thanks for the
Hi.
great panel. Hi. All right, just a couple of quick questions. The first one is for Professor Jesse Fried, and the second one, anybody in the panel who would like to take it. So the first one, in the context of law proofing of insiders, I wanted to ask Professor Fried, to what extent do you think this really gets factored into the price of the securities? So do you think it really gets reflected in how US investors value the shares of Alibaba when they really invest in them, knowing fully well that actually there is some sort of law proofing going on and maybe they won't be able to get access to them?
So I think that there's a China discount that's applied to Chinese stocks for a number of reasons. One of them may be the law proofness problem. There's also another problem with a lot of these companies. Their ownership structure is legally fragile. It's something called the VIE structure. So there's some discounting going on, but the key question is, like, is it enough? So, if you need a 30 or 40% discount, but investors are discounting it by 15% because they don't understand how bad things are, then they're going to be hurt. They're going to be overpaying for the stock, at least at the IPO, and I guess thereafter as well. So we don't really know. We don't know if investors can fully price enforcement risk and everything else, then that's an argument for basically allowing private ordering at the IPO and letting entrepreneurs come forward and offer a package of rules, which then the government would enforce, but they would tailor it to their own circumstances. Unlike the situation we have today, at least for American entrepreneurs, where there's no tailoring allowed.
Yeah, sure, but I guess then they don't have the disadvantage of that discount at the same time, right? So I was just thinking if a Cozian bargain works to solve the enforcement problem, but maybe it doesn't. I don't know. So the other phenomenon which I often think happens. So there's China, but then there's a market like India where Indian companies often issue ADRs which are trading in the US. And we as local investors free ride on the disclosures that are made to the SEC. And often the disclosure quality on the NASDAQ, etc., is much better than the disclosure here. And we get to, the price formation is often influenced by that. And now we're living in a world where local investigation begins because we are free riding on the disclosures made there. So you may even see a reverse phenomenon happening, and maybe it doesn't happen in China, but we've seen that happening in India. And I don't know, what do you think about that, where each jurisdiction, without having sophisticated coordination mechanisms, is actually free riding on better quality governance somewhere else?
Yeah, so I definitely think that when Chinese companies list in the US, even though we like to call the insiders law proof, I mean, there is some improvement in their sort of regulatory situation from the perspective of investors. They're probably being more careful about reporting things. The volume of reporting goes up. That that can help them boost their share prices in their home market, just exactly, the way you described. This is called like the bonding hypothesis. It was developed by a bunch of people about 20 years ago, that companies go to the US, they subject themselves to tougher rules, more disclosure. That actually allows them to trade at higher prices in their home markets, because people feel, they get more information. They feel like, well, the SEC is sort of watching. And I think that's right to some extent. The problem is that the SEC doesn't really police these companies that well. And so if they're doing bad things, we don't know whether the SEC is actually figuring it out. And if they do really, really bad things, or if the insiders do really, really bad things, Americans are powerless, at least when it comes to, China-based insiders. And we know this from sad experience.
Other questions? Any other questions? Feel free to jump in.
Yesha, I have a question for you.
Sure.
Can you talk more about the trilemma?
Sure. So the trilemma is basically a model for lawyers. It's our version of a little model. I'm just joking. But it basically refers to the fact that when you're trying to balance three values, and of course there are multiple different values that regulators can use. But if you're trying to balance three values, meaning securing market integrity and strong governance, trying to promote financial innovation, and doing so through clear and simple rulemaking, that you can only really expect to achieve two out of these three outcomes successfully. And that really is only when balancing these three values.
But see, I would think that you might only be able to achieve one. So why do you think you can achieve two? No, I don't have any. It makes sense without actually getting into it and sort of understanding more about what you're saying, that you can't do three. That seems really hard. But why do you think you can do two? I guess that's the question.
We think that when you're looking at innovation, you have to achieve innovation through some kind of mechanism. And that mechanism we consider to be the rulemaking mechanism. So if you're trying to achieve it through some kind of rulemaking that is very permissive, so you just tell firms, well, by all means, go for it, no big rules apply here. That mechanism plus the innovation means that market integrity suffers. So, the instead of rules clarity necessarily being a goal, it's kind of like a mechanism to achieve either innovation or the market integrity, in terms that I think you're trying to get at. Which is, yes. Hi,
I have
Coach.
a question for you and Jesse. Here is the question. You mentioned fintech lending. You use a bunch of information, probably different from that is used elsewhere. So the good news and the bad news. The good news is that loans are made which could not have been made using less information. So in other words, marginal borrowers get loans. On the other hand, there is a blatant disregard for various kinds of privacy laws. Alibaba is often talked about in that sense. So is that an accurate kind of thing? Is there a disregard for privacy laws of all kinds, even though on the good side, some loans, bad borrowers are able to actually get loans?
Yeah, I couldn't agree with you more. So basically, when you're looking at online lending, there have been studies that are looking into whether or not it promotes financial inclusion. Now, the study with respect to the Lending Club was actually inconclusive about whether or not it did, but certainly anecdotally anyway, there are more borrowers that are being included within the system because of using alternative data. In the case of Ant Financial, for example, Ant Financial takes 3,000 variables, not 3,000 variables, data points with respect to your person in order to decide whether or not to lend. Now, obviously, that's going to raise a question with respect to privacy, and the same thing goes in the US when they're taking data off of your phone. What's interesting about both these jurisdictions is that none of them are particularly protective of privacy. So neither China nor the US has particularly strong privacy rules, and most folks simply consent to that information being downloaded. So I do wonder to what extent, right, borrowers are conscious of the trade-off, as well as the fact that in most cases, borrowers may not care about the trade-off to the extent they need the money. Particularly if you're in the marginal category, you need the liquidity, and so you may be very happy about trading off privacy in that context.
Is the big firms in China much worse than the US in terms of privacy?
I don't know about the privacy laws in China per se, but in terms of the overall protective framework for privacy, the protections that you would normally expect for data integrity and other things, and for example, in the EU or now in California, is just generally a great deal weaker. But I'm not a Chinese lawyer. It's just the reading and the understanding of it.
Does Jesse have a perspective on that?
On Chinese privacy laws?
First of all, the Chinese privacy laws, and secondly, the enforcement of the laws that might actually exist.
My understanding, just from like reading the newspaper, and I don't have any more knowledge than that, is that China doesn't really care
Believe
so
in
much about protecting individual privacy. The government's collecting massive amounts of data on people and using it for all sorts of purposes. And I think companies can do that as well, as long as they're aligned with the Chinese Communist Party. That's sort of like an important thing there now, that there are Chinese Communist Party people embedded in every company. And basically the companies are sort of expected to sort of act in accordance with the interests of the party. So it's not in China, people are not subject to regulation in the same way they are in the United States, where you have laws, you have an enforcement agency, and sometimes they show up and they want to make sure the law is being followed or whatever. It's much more organic and fluid, and but you don't. The bottom line is you don't really see the types of privacy laws like you see in Europe.
That's okay. Thank you.
Madhu had a question. Madhu, are you there? For Jesse, I think you had a question for Jesse, Madhu.
I just typed it out, so it's so basically our big lenders in this QIB market to these foreign firms, through tax haven SPVs. Are these QIBs also getting squeezed because of Chinese firewalls?
So I know that so I don't know to give you a very quick and most brutally honest answer. If the Chinese debt is being just passed on to people that are sort of don't care or willing to take the risk, then I sort of doubt there's adequate enforcement provisions built in. If it's actually being held by sophisticated parties, they would want to have some assets that are pledged or reachable outside of China. Or if the Chinese party basically signs up for arbitration, then foreigners can reach that Chinese party, because the Chinese are signatory to international arbitration agreements, and they do follow them. The problem is that in corporate governance disputes involving public companies, you don't have arbitration provisions. If you want to enforce your corporate law rights or securities law rights, you have to go to court. You get a judgment, and then that doesn't work. But if there's an arbitration agreement somewhere in a deal, that'll work.
Last question. Go to Jesse, you froze.
Oh, I froze?
Okay. A little bit, yeah.
Okay. Did you hear anything I said?
Well, most of it. Only the last 2 seconds frozen.
Okay.
Yeah, that's good enough, Jesse.
Madhu, did you get your answer, or do you want me to repeat something?
Yeah, I got the message. Thank you so much.
Okay.
I got it.
Sure. Okay.
So I think it's fitting if Susan gets the last question. Susan? Our COVID vaccine, human COVID vaccine, where are you?
Hey, Isha.
There she is.
Yeah, so, thanks for the story on And. I thought that was a really lovely threading of all these pieces together. I just wonder though about your trilemma story, which I found fascinating. You should send us the link to the paper unless it's on SSR and I'll go dig it out. Is where in the trilemma story does the Ant-IPO shutdown fit, right? I mean, so one of the, by the way, your concern about fintechs is really spot on, because I think that there is a sense that fintech is innovation. It's too new. People don't know how to regulate it. Therefore, you can't make the promise of market integrity. In India, there is a sense that there are several lending companies, which are actually just lending companies, maybe not even banks, but which, when they present themselves as fintech, get a much more lax approach in terms of regulation, heightened valuation from the investors. And so there is this incentive for a normal lending business to just present itself as fintech and you get away with things. And I'm wondering, how does the trilemma story explain this? And if I were to buy into the trilemma framework, what would be the optimal approach to use to regulation of fintech? And you must end this story by telling me why it is or where it is in the trilemma that Ant failed. Okay.
So the ant, no, thanks, Susan. The ant failure is fascinating because the reasons that are offered for it are obviously connected to the slanderous comments and the political story. But you know, there is, I think, I think there's a real concern here about what Ant is and how it functions in the Chinese economy. The trilemma story here functions very clearly, which is that the Chinese government gave Ant Financial enormous permissions to innovate. So over the last, since 2006, essentially, Alibaba and WeChat, Tencent, have had enormous latitude to grow their own payment networks. They don't use the bank's payment networks, they use their own. And to spread far and wide in terms of not just payments, but also to use that payments, the data that Koshi was talking about, to then do online lending. Ant Financial has an asset management arm. It has money markets funds. And they've essentially been allowed to grow with enormous latitude. So this is rule simplicity and innovation as being the two guiding values here. And the result, of course, is that you end up with a firm that's now posing a real risk to market stability. And that's really the reaction that seems to be explaining the IPO shutdown, which is the Chinese authorities trying to either scale down Ant Financial, to require Ant Financial to temper down its operations, or to warn the public about what exactly the business it is that Ant's doing. Now, what's interesting is the Chinese have brought in a new law that's designed to tackle fintechs and the business that Ant Financial is doing. So they seem to be moving in a more different direction, which is to create a complicated rule book to try and capture both innovation as well as market integrity. But this is a late reaction to giving enormous breadth to these two giants that just grow and grow and grow.
Okay, so can I ask a quick follow-on question? So, this entire conversation started because of Jesse's talk at the Emerging Markets Finance Conference last year about how the US regulators appear to be much more lax in terms of customer protection when there are these foreign companies that are listed. And I'm just curious, why did Ant, and maybe this is not for the general conference, but why did Ant choose to list in Hong Kong as compared with do the same route of going the Alibaba route, where you go through Cayman and you list in the US? And I thought perhaps there was a regulatory change that strengthened customer protection for and to plug exactly the kind of loopholes or gaps that Jesse was talking about in last year's EMF. That's one of the questions that puzzles me. And I thought that was the reason they went to Hong Kong, because there was a shutdown of the loopholes in the US. Is that true?
Yesha, can I answer?
Go for it.
So Ant is domiciled as a Chinese company. So the Chinese regulators would not allow it to list in the United States. The question is why Ant is domiciled as a Chinese company. And I think, and I'm just speculating here, that Jack Ma knows that he needs sort of the buy-in of the Chinese government to make Ant work, or he knew that. And so he basically wanted to make it a pure China company. And that's one of the reasons why he wanted a list on Shanghai, because this would bring enormous prestige to that market.
Okay.
So if in principle, Ant could have been structured as just like Alibaba with a Cayman holding company and listed in the United States, and it probably would have done well, but it was not structured that way, and I think it was sort of to please, the Chinese government.
Okay. Hey, but yeah, so this is fascinating. I mean, thank you all. Thanks, Yesha. Thanks, Jesse. Thanks, Koshi, for having put this discussion together. I promised Yesha that I would stay awake if the story was told. And here I am. I mean, I'm not even sleepy, right? So thank you so much. Yesha.
And thank you. Thanks everyone for a tremendous session, for the great papers, and Koshi and Jesse for an awesome panel discussion, and obviously everyone in the room for your contributions and thoughts. Again, this is a wonderful session. I wish we could just, be together and get to go and have tea and chat without
Next year.
any social distancing. Next year.
Next year.
No social distancing, zero. Thank you,
Thank
guys.
you, Yesha. Great
With a new-
job. And
Thank you, Yesha.
Susan, wonderful
Thank you,
conference.
guys. Thank you,
Yeah.
Susan.
Great
Bye.
organization, Yesha.
Good
Thanks,
night.
Brian. Bye, guys.
Bye.
Bye.